A private credit fund statement can show high income, double-digit yields, and flawless performance, while the physical cash drawer beneath it remains sealed tight. The entire private credit market was built on a very specific exchange. Investors provide patient capital to specialist funds, and in return, they receive high, steady yields from loans made directly to middle-market companies. For years, this functions perfectly as a paper exchange. The fund issues customized loans on one side of the ledger and records the incoming interest on the other. The vulnerability appears the moment that paper exchange faces physical demands. If borrowers conserve liquidity exactly when lenders and investors need it, the structure fractures. A recorded yield on a monthly financial statement offers zero protection if the actual cash is locked away. The tension between recorded yield and available cash is now actively being tested by major institutional investors. This chart captures a massive spike in Q2 2026. Investors sought to withdraw $4.7 billion from two enormous private credit funds managed by Blue Owl, dwarfing standard historical averages. The concentration of these requests was severe. The technology-focused OTIC fund received repurchase requests equal to 38.1% of its total shares, while the larger OCIC fund saw requests hit 18.8%. Both of these demands hit a hard wall. The funds maintained strict quarterly withdrawal caps of 5%, meaning the vast majority of that requested capital stayed exactly where it was. Blue Owl maintained that both funds had sufficient liquidity and did not actually need to sell underlying private loans to meet these specific tender offers. But the friction exposed a structural reality. Investors believed they were holding a liquid yield product, while the fund itself held assets that could not be instantly converted to cash. This dynamic is driven by a precise structural conflict known as liquidity mismatch. On the liability side of the balance sheet, investors expect speed. They subscribe to a fund assuming they can utilize periodic redemption access to get their money back on a predictable timeline. On the asset side, the fund holds private, highly negotiated corporate loans. These assets are difficult to price and do not trade by the second like public stocks or listed bonds. The fund's promise of liquidity is weaker than the investor's expectation of liquidity. If a mass exit is attempted by investors, the underlying assets simply cannot move fast enough to support it. The cash flow problem is compounded by an accounting mechanism that keeps the drawer empty while the ledger looks full: payment in kind interest, or PIK. This flow path diagram shows how a traditional loan operates. Cash interest moves in a direct, uninterrupted pipeline from the borrower directly to the lender. A PIK loan alters this route. The borrower defers that cash payment. Instead of traveling to the lender, the unpaid interest is routed backward and added to the original loan balance. Yet the lender legally records this deferred payment as income. The fund's reported yield climbs, but the cash pipeline remains entirely empty. PIK income is a standard accounting practice. The debt may eventually be collected in full, but when borrower stress coincides with investor redemption requests, recording paper income offers no practical defense. It shifts the burden forward. It takes today's recorded income and converts it entirely into tomorrow's repayment risk. The effects of this accounting are already visible across the wider industry. A Reuters analysis examined 53 publicly traded business development companies in the first quarter of 2026. This grid represents those 53 lenders. By Q1 2026, 28 of them had dropped into a loss-making state, driven by writedowns, rising debt costs, and falling loan values. Looking at this metric, the median dividend coverage based on reported net investment income appeared incredibly stable, sitting at a near-perfect 0.99 times. But when PIK interest is stripped away from that calculation, the median cash coverage plummets to 0.89 times. Adjusting for this non-cash interest revealed that 33 of those BDCs had a cash coverage ratio below 1.0. They could not cover their dividend obligations with physical cash. Financial products marketed specifically for their stable income generation are increasingly relying on paper accounting entries to justify them payouts. The vulnerability was built during the market's rapid expansion. When commercial banks pulled back from lending due to regulatory constraints, private credit funds rapidly stepped in to finance middle-market businesses and leveraged buyouts. As an enormous wave of new capital chased these private loans, spreads compressed. Lenders accepted weaker borrower protections and looser underwriting standards just to deploy the incoming money. Investors looked at the resulting assets and made a logical but dangerous calculation. They mistook a lack of daily price movement for a lack of underlying risk. The structure of private credit did not eliminate market volatility. It merely delayed the realization of that volatility until the cash was actually required. In public markets, prices update continuously. The constant fluctuation is uncomfortable, but it provides a transparent signal of value. Private loans operate in the dark. This diagram compares the two. Public markets trace a volatile, jagged line. Because private loans do not trade daily, their valuations form a smooth, steady curve, dictated by internal models, infrequent appraisals, and manager discretion. Funds then borrow money on top of these artificially smooth valuations. This leverage is applied to amplify returns, assuming the credit remains stable. If borrower earnings weaken and those loan marks are forced down, the cost of that borrowed money spikes. The leverage immediately begins working in reverse, crushing the fund's margins. The exact financial architecture designed to amplify yield is the same machinery that amplifies systemic stress. Private credit serves a highly necessary economic function. It provides customized, flexible financing to software firms and middle-market companies that traditional banks avoid. But it only functions safely when funded by genuinely patient capital. To diagnose the health of these funds, the yield is no longer enough. The essential metric to track is cash income coverage, strictly after excluding all PIK interest. The critical question is not the size of the payout. The question is, what conditions must remain true in the real economy for that paper yield to manifest as physical cash? The greatest selling point of private credit is privacy, but privacy reduces price discovery, obscures stress, and hides the rot, until borrowers, lenders, and investors all demand liquidity at the exact same time.